According to a new study, nearly 200 banks across the United States may be at risk of failing if half of their depositors suddenly withdraw their funds, much like what happened to Silicon Valley Bank. The concern is that many of these banks hold a significant portion of their assets in interest rate-sensitive financial instruments, such as government bonds and mortgage-backed securities, which have dropped in value as interest rates rose over the past year. Silicon Valley Bank's loss of nearly $2 billion sparked a panic among its customer base, leading to a social media-fueled bank run. Now the study suggests that many other banks could be vulnerable to the same fate if a high percentage of worried customers attempt to withdraw their deposits. While the government has promised to back all depositors in an effort to prevent further panic, these banks may still be at risk without intervention or recapitalization. Bonds are debt securities issued by corporations, municipalities, or governments to raise capital. When an investor purchases a bond, they are essentially lending money to the issuer for a set period of time, during which they receive regular interest payments. At the end of the bond's term, the issuer repays the original loan amount to the investor. Many banks invest in bonds as a way to earn interest income and diversify their asset portfolios. However, bonds are also subject to changes in interest rates, which can affect their market value. When interest rates rise, the market value of existing bonds decreases because they offer a lower interest rate compared to newer bonds issued at the higher interest rate. If a bank has a significant portion of its cash reserves invested in bonds, a decrease in the value of these bonds can lead to a decrease in the bank's cash reserves. This can be a problem if the bank faces sudden demands for withdrawals from its customers, as it may not have enough cash on hand to meet those demands. In the case of Silicon Valley Bank, it invested heavily in long-term government bonds, which are generally considered safe investments but can also be affected by interest rate changes. As interest rates rose, the value of SVB's bond portfolio decreased, leading to a loss when it had to sell some of those bonds to meet customer demands for withdrawals. This loss, in turn, sparked concerns about the bank's solvency and led to a bank run.